Welcome to Total Money Management, the Signals and Noise podcast, week ending October 31. How we doing, gents?
Happy Halloween.
Happy Halloween if you're an American.
Jacob walking around with a chainsaw.
I did bring a chainsaw.
Yeah.
Not a chainsaw, it's a hedge snipper. Thank you for that, by the way.
How are we, lads?
Good, mate. It's been a week.
Very well.
Been a week.
been a
It's
bit.
getting busy out there.
It's been a whole week. Yeah.
Things are getting a bit crazy.
It was a bit choppy.
We could just do a podcast secretly and never put an end date on it, and we could just repeat the same thing every week.
Isn't that what we've been doing?
That's
Well,
what
kind of. We just come in and adjust the cape ratio. Oh, 41. Oh, 40 this week.
Feedback time. So I was talking to mummy senior, and she was like, "I love the podcast, so shout out, mum." And she's like, "But I just don't understand anything you're saying."
She doesn't understand.
Yeah, bless her. She's following along. She's like, I feel like you need to do a 2 or 3 part episode of common words that you use and a baby explainer of them.
Right.
So I might take that on board and chat to the boys.
Well, she'll like the first short story. Trump, okay, trade, and terbium.
That's it.
Right?
Do you understand that?
Done.
Righto. Mrs.
Terbium.
Senior, terbium is like a rare earth, and if you get the chance, buy some. Not advice.
Not advice. Direct
Anyway.
from Steve. But yeah, I thought.
It's all a bit crazy. We kicked off with the cape ratio there, which is at 41, which is,
When is this? This is of a couple of days ago, is it?
yeah,
Yeah.
it'd be good if you could put it up onto this week, mate, since you got last week's up there.
Is that?
Hello. How's
You
that-
can tell I haven't read the notes.
How's
Call me out
how's that wine
publicly.
going, mate? All right.
Yeah, I'm clicking into last week's.
So the reason why the it's up there is one of the things that happens in a bubble or when markets are expensive is it stays expensive for a long time, and it's like if you become aware, if you're sort of like you buy a green car, right, and then suddenly you see green cars everywhere, right, and it's because you become conscious of it and you're sort of looking at it, and it's the same with Cape. If you look at Cape. If you don't know about Cape and, someone like us says, oh, you got to pay attention to this thing, people look at it and go, man, that's like, oh, okay, that's really expensive. But then it goes from 30 to 40, right? Mm. And what happens is you get lazy, and that's why I sort of emphasize to people, when the market's really expensive, you want to bring in your rebalancing, not make it annually, make it maybe 6 monthly, or make it when it hits the 200-day moving average, because the complacency sets in where you go, oh yeah, that Steve's been talking about that forever. That's never going to happen.
It doesn't work anymore.
That's exactly right. And I saw a tweet this week, which was Warren Buffett. It might have been this week or last week. Warren Buffett sold his Apple too early. And it's like, oh God, here we go. And then there was one this week. Warren Buffett's underperformed the S&P since he announced his retirement.
Yeah,
that
was a couple of weeks
yeah,
ago.
Didn't we literally review his performance against the market a week or so ago?
Yeah, well, that's what I mean. It might have been a week ago.
He has outrageously outperformed it.
People
Yeah.
are cherry picking dates though, right? They're going, okay, since
Yeah,
this
true.
date
Yeah, since
to
May.
this date. Exactly.
And that's the problem. Always picking the start date is where people get caught, because it's not the same for everybody, right? And that's the really important part that investors have got to work out, even if you've made a lot of money, right?
Yeah.
Because, if you invest in March 2009, I started in that period in April 2009. So there's been lots of money made, but that doesn't make up for the point that if I lose 50%, then I'm still gonna go down a lot of money, right? Which reminds me, I wrote about that in the blog this week, right? And showing people that you've got to really learn to avoid the big losses, because that's what sinks your compound return.
Yep.
You can be compounding at 18. Let me give you an example. 82 to 2000, you compound at 16. If you go to 2010, you're compounding at 8, right? And the problem was from 2000 to 2010, you halved.
Yeah, the volatility took you out.
Yeah. Well, the big drawdown took you out.
Yeah.
Right. But yes, the volatility took you out.
So one thing I've been thinking about the last week is we talk a lot about CAPE over 10 or 20 years, 10 years, but over the long term. A lot of our listeners are actually just investing now or within the last 12 months, say.
Yep.
So it's a little bit different because they've only ever seen a CAPE of 35, 38, 40.
Yeah.
So for someone that hasn't had that huge run,
Yep.
how would you think about it?
Well, you have to be prudent and look at the valuations and think about, because I was thinking about this on the way here. If you look at the tech stocks, they're just crazy, right? You'd have to be the only way. I shouldn't say the only way. The way you've got to look at it is say, and I think we mentioned this a couple of weeks ago. You've got to have your timeline right? And it's that classic stuff where you buy something, and then it falls 50%, and you go, "Oh, I'm a long-term investor," and it's like, yeah, because now you're down 50%, right? And what I mean by that is people invest thinking, "Oh, I'm going to make a lot of money soon." Then when it doesn't make money, you go, "Oh, okay." So the point being, if the market is expensive, you have to say to yourself, okay, I'll wait until it gets really cheap. And because what I'm trying to impress on people at the moment is it's going to get cheap.
Yeah, there's a huge opportunity coming.
Yes, absolutely.
Which is why we stress the asset allocation, don't lose money.
Yep.
The uncorrelated asset to be able to put yourself in a position to take advantage of a significant decline.
Yeah.
But also we understand that we want to participate in the melt up as well.
Yeah, I generally say to people, look, if you're starting out and you're young, I say to people, just have a few bucks, right? So if you've got 50,000, right, and you're sort of like, oh man, I've just learned about CAPE, but God, I really want to invest. It's like, okay, put 10,000 in the market, right? Just don't go all in. And start out, we've talked about, previously talked about energy stocks, right? So, I'd say to people, all right, well, look, just put, allocate 5,000 and put 2,500 to it.
As an example.
Right? You got 100 grand. Okay, well, spend 20, but keep 80 in cash because you're going to invest that 80 later on at 11%, not the current rate, which is about 3, right? So, the S&P, the CAPE earnings yield is, the CAPE's at 41, right? 100 divided by 41. So the CAPE earnings yield is about 2.43, right? Which means that's what you should expect over the next decade. Inflation's running at about 3. Bonds are running at 4.
And it's not going to run down linear. It's going to have a huge drawdown, and then it'll bounce back, and then the volatility will swing down. You'll end up probably losing more in the volatility because you'll make some stupid decisions.
And if you don't have a strategy, you get sucked into the bear market rallies.
Yes, especially as a young and inexperienced investor, right? That's where and again, we talk about this all the time. Don't lose money means basically don't do dumb shit. Right. But it's really hard to do because when you're inexperienced, and I was talking to, shout out to Jared. I was talking to Jared today about this. It's really hard. I sort of say to people, I want to teach you what it feels like to lose money, but you don't actually lose the money. Right. So it's the same as saying to someone, look, I'll tell you, if you touch that flame, it'll burn and it'll really hurt. Well, you can sort of go, got it. But you don't actually know what the pain is like because you haven't touched it, right? That's why kids touch the stove and they burn, right? And that's the last time they ever burn themselves by touching the stove. Yeah. And it's the same for investors. It's hard to say to people, if you invest money now, over a decade with the CAPE at 41, you're probably going to lose money, right? Or you're probably going to ride 20%, you're probably going to get really excited, and then you're going to have an almighty drawdown where you freak out and sell at the bottom of the market, right? The reason why is because you haven't got the experience to override what your emotional brain is doing, right? You haven't got the knowledge on the sort of system 2 brain side to say, okay, all right, okay, yep, I'm just going to have, I've got plenty of cash. Okay, yep, Steve said this had happened. All right, I'm just going to calmly have a look at this and, see how it pans out. Most people just completely freak out, right? And the thing that does that is the volatility. And that's only after you lose money you go, right, well, I won't be doing that again.
Yeah, now I get it.
Right? And that's the really, really important lesson.
Or you're
and
a psychopath and you keep doubling
Yeah.
down.
Well, how many penny stocks have you bought?
Yeah.
No, but like how many penny stocks have you bought since Mustang?
Since zero. Not
Yeah,
one.
even when we have someone giving us some really good penny stocks.
Yeah. I haven't bought a
Scared of the
single penny
stove.
stock. Yeah.
Yeah.
Terrified.
myself.
Yeah. It's so perverse, because it's a negative, but it's the only,
But give me $1 million and I'll chuck it in Bitcoin.
yeah.
It's different.
Let the exchange hold
You've
it.
learnt nothing. But it's true, right? It's, Nassim Taleb has this chapter in his book in Anti-Fragility called Via Negativa, right? And what it means is you learn from the negative things, right? And what he says is, that I think the Buddhists also have the philosophy of what you should do is take things out, right? So don't add things into your life. What you should do is take things out of your life, right? To make your life really simple rather than more complex. And what often happens is you see that people who make a lot of money end up making their life a lot more complex. Right, they got trust funds, and then they're invested here and they're invested there, and they got this going and they got that going, and all this sort of stuff. Right, when it's not really necessary. Right, it's just like, hey, just keep, and it like we teach. Right, just keep it really simple. You'll make money doing really simple stuff. You don't, if anybody walks in and they got a spreadsheet and all these formulas and all that stuff, it's a guaranteed way to lose money, right? It's the simple things are like ETFs, right? I don't know how many, what iron ore's doing and BHP's doing and all that sort of stuff. But I can say I know how the market works and I can help you make money over the long term by simply just using the index and asset allocation and rebalancing and market cycles.
Well, people associate skill to complexity, though. You look at a huge mathematical
Yeah,
equation on a
absolutely.
a chalkboard, when actually it results in 0 or 1 or something
Well,
like that.
yeah.
That's why you got to have 9 screens as a trader.
Yeah. But
make
it's
money.
also, it relates what your mum said, right? Like, if people talk to you about something that's their expertise and they use a lot of words that you're going, I don't know what this guy's talking about, you tend to think, well, they must know what they're talking about.
Yeah.
Right? Rather than saying, this guy's absolutely full of shit.
She's figured us out. We just come
Straight
on here
up.
every week with
Straight
big
up.
words.
Yeah. Dysprosium. So, but it's true, right?
So the
It's-
listeners are now going to be like, Steve's full of shit.
Yeah.
He keeps saying big words about rare earths.
Terbium and neodymium and praeodymium.
Praeodymium, right?
Anyway,
now,
it's
not a real one.
speaking of which,
Go on.
that is serious. Trump went to Asia this week, and I'm not kidding. Most of it was about doing deals with countries for rare earths, right? And that's why I'm saying it's really, and that's below the paywall. The stuff about rare earths, right? Because it's really, really the number one issue. There's one issue in China, semiconductors, right? They want the latest chips. There's one issue in America, rare earths, right? They want the rare earths.
That's one of the issues.
Yes, but the other issues are the other issues, Tom, are some guy wrote this afternoon on Twitter, right, and said, BYD have got the best cars and, blah, blah, blah. Okay, fine. America can live without BYD. They can't live without rare earths,
Yep.
right? That's the point. So a lot of things, and strategists in America will be sitting there going, okay, what if China said, listen, we're not sending you any more T-shirts? America would go, yeah, okay. Fine, we'll go to Bangladesh. We'll go to Thailand. We'll go to Malaysia. There's plenty of places to
Yeah,
make
someone's
T-shirts.
going to sell us shirts.
Someone will sell us a shirt. Rare earths are the one where other countries can say, dude, can't help you, right? So that's where Lynas is really, really important, right? Because it announced this week that it's building a heavy rare earth processing facility in Malaysia.
Is that the stock of the week?
No, it will. Interestingly enough, declaring it, I hold Lynas and I have for a long time. It was at about $20. Now it's actually back down to about 15. But a lot of the hot air has come out of all of the rare earth stocks, right? Because they shot up,
They went nuts.
80% in a week or something.
That's expected, right?
Yeah. But now they've come back down, and that's expected because what happens is traders get in, they spot a trend, they jump on, they make 40 or 50%, then they get out.
Yeah.
Right? But there's also the other thing you can probably expect there is that the companies will fluctuate a lot based on what's happening between the US and China, right? So this week they came out. Someone came out this week and said, "Oh, the Americans have the American rare earth problem's going to be solved because they've got this new technology or something," right? And you see this all the time, right?
Something new and shiny comes out.
Yeah,
and fix the issue.
Yeah, China comes out and says, we've got a chip that's better than your chips. It's like, no, you haven't. And it's the same with the rare earth stuff. It's a bit like, no, you're just bullshitting, right? So there's all this sort of stuff. But I think what you'll see is you'll see a lot of M&A activity in the rare earth space.
From the big players.
Yeah, the big players will and small, a lot of small miners, it's a hard game. Right, one of the big blokes walks in and says, "We'll give you double the price." You look at it and go, "Yep, great."
So, would you say Lynas is still well valued, even after it's run and?
Well, it's a little bit hard, Jacob. It
says that the PE ratio is 1,500.
Yeah, it's a long-term story, and it will be It's one of those. Let me put it to you this way: it's like AI. Right? The rare earths are important, AI is important, but what's the future value?
Yeah.
Right? So this is why we
where's the money flow going to come from? From government?
One of the strategies is saying, like we talked about statistical arbitrage, is saying just buy little bits of, buy 20 rare earth companies and put $1,000 in each of them.
Yeah.
Right? That's the way to do it, rather than say, I'm going to put 20 grand in one of them and hope like hell it succeeds, because your risk has gone through the roof.
Like ASM?
Yeah, well, there's them and a few others. They're Australian ones. They've been at it a long time.
ASM did 80% this month.
What's that?
ASM's gone up 80% this month.
Yeah, but it went from 50 cents to $2. Now it's back down to what, $1?
It's $1.
Yeah, that's what I mean. So, and this is again really important. Imagine if you bought it at $2.
Oh, someone did.
That's right.
Yeah.
So someone's looking at it going, "This is bullshit. I'm down 50%." That's where you've got to be careful, right? That's why I say put $1,000 in, because if you look at it, you can go, all right, well, I can at least, double down on it or dollar cost average down.
Well, I mean, it's fair to say the rare earth story is not going anywhere. It's part of a massive shift in
I think so,
politics
yeah.
and geopolitics and for the next decade.
Yeah. Put it this way. If the Americans were on the cusp of going, hey, we're going to nail this shit and, we won't need any rare earths. If that was the case, Donald Trump wouldn't be going to Asia or Australia and making shitload of rare earth deals, right?
Yeah.
It's going to be around for a little while yet.
So what else we got? Gates is reversing course, parapolitics, and then I saw this. He'd basically dropped that AI is a bubble, and I think a few of the big wigs are saying that now.
Yeah, well, that's three of them. That's Sam Altman.
Yeah,
Jeff Bezos.
they're wanting to get out the firing line for if shit hits the fan.
Yeah, I think if it crashes, they'll be able to go, well,
told you
it was a bubble.
But you can say, told you so first.
Probably, Tom. I think so.
But interestingly, who's the NVIDIA CEO?
Jensen Huang.
He said it's not.
Well, he wouldn't, would he?
Yeah, because he just hit 5 trillion market
But it's
cap.
just interesting how you get three of the big wigs saying it is and one of the big wigs saying it's not.
And he's selling down his shares.
Mate, his stuff sits in the data centers for all that tech.
Look at what they do, not what they say.
What's that?
Look at what they do, not what they say. So, I mean, he's selling down his shares.
Yeah. I think the interesting thing, what I was saying there, Gates reverses courses. Gates came out this week and said, climate change, yeah, well, it probably won't kill us all. Now, remember what I said a couple of weeks ago, I'm feeling a little bit shaky about climate change. You can see what's going on here. Environmentalism's going to be squashed, mate.
That bloke's ridden on the climate change coat strings for 20 years.
Yeah, exactly. But now all of a sudden,
it.
it's like, oh, it's not going to kill us. It's like, oh, okay, hello. What's happened here?
Yeah, it's just an ice age.
Yeah. But it's true, Tom. Why would Bill Gates say, I'm now going to make an announcement that, we shouldn't panic too much? Well, I'll tell you why. Because Donald Trump's in government and he's telling these environmentalists to, maybe...
I'll cut your funding if you don't change your tune.
Yeah.
And he's building he's investing in massive data centers with...
Yeah,
and
absolutely.
I'm going to give you money for this data center, but you've got to tell everyone that climate change is a hoax.
So, anyway.
Let's talk about Australia then. Obviously, property. Did you want to do your weekly stint on
Well,
property?
hang on. What's the US rate cuts but not for Oz?
Well, they had a rate cut.
Well, the US cut 0.25%.
Okay, we didn't.
And I must admit, I'm
End of story.
next year, I reckon's...
That's it.
Next year, I reckon it's going to be a problem.
Yeah?
For us.
Yeah. No, for the US.
Yeah.
I think their economy's sliding really quickly. Really quickly. Now, Powell is cutting rates to placate Trump a little bit as well. But I think I said last week, the government deficit's falling. They're collecting a lot in tariffs. The government shut down. That all weakens the economy.
Yep.
Right, and the investment side is purely the Mag 7, right? So in the Mag 7 are basically holding up the US economy through investment, right? And that's going to be, and that can't continue on.
And the S&P.
And the S&P, yeah.
Well, I saw a graph.
And the Russell 2000.
That's going to absolutely, yeah, yikes.
The growth of, I'll not do this justice, but I think it's 397 of the S&P companies have just gone nowhere or even declined for the last few years. And the other ones have gone...
Yeah, dragged it up.
Have just dragged it up.
NVIDIA.
Yeah.
Mostly
really
the,
strong
most
shoulders.
of the top 10.
Yeah, NVIDIA, basically the Mag 7.
Mm.
Right? The other 493 have done bugger all.
Is NVIDIA in the Mag 7?
Yeah, it's the number one, mate. So and in Oz this week, we got the inflation figures out, which were no one, of course, predicted again. God, I love economists. I love them.
No one could have seen it.
No one could have seen this
They
come
were higher
in,
than
and it's like, oh God, they're dickheads. Anyway, moving right along. We didn't cut. What they're now saying is, well, the Reserve Bank won't cut rates because inflation's still high, right? So mortgage holders go, oh no, right, because then they don't get mortgage relief, right? So, and our economy's not doing that well. It's okay, but it's just ticking along.
I put something in the Instagram members channel, and apparently the main contributors to inflation are selected goods, whatever that is.
Yep, and energy.
And services.
Yep, and energy. Part of it was because, see, the government gave us all money for the energy bills, and I think energy went up 9% or something, and I think rents were 6%, I think, or something. So, yeah, but things are expensive. They're a lot more expensive than they used to be.
Yeah, I mean, if you look at this little line, you can't see it, but we're the highest we've been since 2021 almost. Obviously, throughout COVID went crazy.
But inflation.
Yeah.
That's the concern, see, because it spiked again.
Yeah.
And that's the government stopped paying the electricity bills. So everybody's electricity bills are, we're all going to get bill shock.
I did
again.
see that on my bill.
Yeah. I know. It's just, it's crazy.
Yeah.
It's crazy.
Did you notice that, Tom, or was it a drop in the ocean?
It does. Mate, top 1%, they don't worry about bills. What's inflation?
I had to slide it in.
I've had it up to here. All right.
With inflation?
He's so sensitive sometimes, now, Tom.
We're on this side today. We can bully you.
Yeah, that's right.
Aussie economy. Well, not Aussie economy. Property prices. You calling it 2026 or top
I
or
just-
2027 top?
It doesn't matter whether it's 26 or 27, right?
It does to me.
Yeah, well, it
I'm
does
buying
to
it.
you. Yeah, that's
what
true.
are you,
That's
what are you
true.
doing? It's not going to crash. We've got the Olympics coming.
That's right.
yeah.
That's
What
right.
are you talking about?
And they're a
The
mere,
US and New
6
Zealand
years
don't have
away.
the Olympics.
Yep.
That's why they're-
Nor does Canada.
That's why they're tumbling.
I'm waiting. I'm waiting every week to see if the banks are slowly lending less to more people.
Yes, that's the key to watch. Watch bank lending, and bank lending, it's increased. Right? So don't go out looking for property this weekend. But in all seriousness, the thing that you notice is the thing that's lending a lot is investors, right? Investors are going piggishly back into the market, right? So, help yourself, mate.
I will. Have I finished
Jesus,
this
you
already?
drink. I'd say this every week.
No.
You guys are
Go
gluttons.
for it.
Have you?
He's got a trick or treat.
I think I need to.
I've still got a trick.
I might need to get some help. No guy.
Dude. Yeah.
Go on.
So the thing is, investors are pouring back into the property market. That's where I think it's a bit of a problem, right? And that's why I think
They've been pouring in the whole time.
well, yes and no, Tom. Yes and no. The thing is, they've rebounded a lot, right? And what I'm trying to say there is, if you were, I'm talking about stocks now, right? The S&P has a dividend yield of about 1%. Okay, so you go in and buy the S&P on a CAPE ratio of 41, and you're getting a dividend of 1%. You're getting an earnings yield of about 2.9. So in other words, that's what you can expect. Okay, property investors in Australia are getting into, you imagine if I said to you, Tom, I've got an investment and the yield is 1%. You would honestly say to me, Steve, that's ridiculous. I'm not buying it.
I'm not buying your courses.
Yeah.
But if people say, I've got a really nice property, you'll love it, it's 2.2 million or whatever, people go, oh my God, right? Because they think it's going to be worth more in the future.
Yeah.
And as I said, they may well be right, but heaven bloody help you if the market turns, because these things are not like stocks where you can just flick them off in a day, right?
Well, this is where I get stuck. All right, and I'm sure we've covered this 100 times. I've probably said this a few times. I don't know. Okay, even if there's no shortage of investors with heaps of money, because obviously there's a lot of people with a lot of money, they can keep buying houses, absolutely no problem. But if rents continue to increase, I don't understand how, the average household is going to be able to justify these rents. They're absurd.
But that's what I'm saying, that eventually that stops, right? Because like you're pointing out, what will happen is renters, let's say you're paying 700, right?
That's cheap.
And the
Why are you
landlord
renting that?
And the landlord says, okay, listen, I'm putting it up to 800, right? Or 770, right? 10%. What's the alternative? The alternative is you say, all right, I'm out.
Yeah, I'll camp.
I'm moving from a 3-bedroom to a 2-bedroom. Kids, you're going to have to slot in the bedroom together, right? Because again, people will ratchet down and try to survive, which means it might be, righto, the 2 kids have got to go in the 1 bedroom, not in 2 bedrooms, because we can't afford it.
Well,
Eventually it reaches a point where it breaks.
Well, masses
Right.
move markets, right, as we know. So I think we've got to keep an eye out on unemployment rates and things like that.
Yes,
If they
yes.
tick up, people can't afford
Absolutely.
people can't afford rent or
Yep.
mortgages, which means that the masses decide that for the landlord.
Yes.
So if let's just use renters as one cohort of people, let's just say it ticks up to 7% unemployment rate. That's a lot of people that are now not working that can't afford, don't have savings to pay that, and the market has to meet where they're at. So rent that was 700 might now be 600 because that's just what people can afford.
Yes, absolutely. At some stage, and this is what I'm saying, at some point, all markets turn, right? They all cycle. Now, the property market in Australia, I was talking to someone today, Jared today, about it, right? I bought in 2000 and I bought in New Farm, right? Perfect area, right? And it went gangbusters, right? And then my ex-wife and I at the time, we had like 4 properties, and it was just, I would go to the mortgage broker and go, oh, yeah, I need 250 grand. He was just like, yeah, righto. Like they were just handing it out like, candy, right? And in 2000, every chart you look at in terms of debt goes, moving along steadily, and then it just absolutely bolts in 2000, right? And it's because of the Asian financial crisis. Now, I won't bore you with it here, but essentially we got flooded with cheap money.
We have 2 property specials about 50 episodes ago where you can go and listen to us talk about it.
Yeah. And look, it's really important because what you've got to realise, what you said before, Jacob, there's only 2 ways to get money into an economy, right? Which is the government spending. Well, Albo's not doing much of that, right? The deficit's like 1% of GDP, right? So that, that's not doing anything. The other side is private lending. Now, businesses will borrow to build stuff because Tom's going to run in and go, I need more widgets. Yep. Well, that's not happening, right? Because the GDP is really low. So where's all the money going? The money's going into the property sector, right? The consumers or the general public are borrowing like crazy to buy and speculate in property. Now, when that stops, the prices fall, right? Because once the momentum falls over, you can say, I want 1.7 for my property. And if I say, Tom, the bank will lend me 1.4, you're quite welcome to say no. But now you're stuck with a property that's worth 1.7 as an investor, and, you're losing money because you negatively geared it, right? Well, okay, that's fine, but that's what's going to happen to someone. I don't know who it's going to happen to. But like we said before, someone bought rare earth stocks at $2 and now they're $1. Right? Well, some people bought at 50 cents and at $1 and they're going, this is great.
It'll happen to me as soon as I buy a lovely house in Melania next year.
Well, yep, and serves your bloody self right.
Yeah. I know it's coming,
and then
but
a month later you'll be mortgage free. And then the next month you'll buy a second one.
I'm just paying cash.
Yeah.
Anyway,
kids first.
No.
Babies first.
House first.
Oh, come on, mate. You got to get on with it. Tom and I have done our bit. Jesus.
Yeah, I got heaps of kids.
You can't bloody help yourself.
Lesson of the week.
Week. Don't have too many kids.
Week 2 of trying to get sued by equity mates. But this is a common one, right? There's a chart here, and if you're not subscribed, go to the Signals and Noise newsletter. It's free for most of it, and if you want the stock picks, you've got to pay because we're not giving you that for free anymore. So what we've got here is years invested, 1 through to 20, and probability of loss from year 1 through to year 20.
Yep.
Basically, what the blokes are saying are, any time after 15 years, you're guaranteed to not lose.
Yeah,
but they don't say what that could be 1%.
Yeah, well, see, that's the point. If you look at, 1982 to 2000, which I always use, it compounded at 16, right? Why? Because the Cape was at 5 and it ended at 44. Okay, well, from 2000 to 2020, it was about 4%. Why? Because the Cape started out at 44.
Yeah.
Right? And then in 2010, it got down to 12. So when they say those things, the probability of a loss is 0. And it's like, okay, but how much do I actually make?
Yeah.
Right? And the point being, in 20 years, you're going to have a good decade and a bad decade, right? If you look at the returns, they generally get pretty close to 10 years, right? But if you use the Cape ratio, you can look at it and say, well, the Cape's at 44. Oh, okay. So from 2000 to 2010, you lost 5% per year. In other words, you halved your money. Now, you can look at that and go, oh, yeah, look, years invested 10, a probability of loss 4.9%. That's like, no. And the other thing
10
is,
years.
well, I'm not sitting there going, oh, good, I've only got a 5% chance of a loss, right? But the loss is 50%, right? So you're sort of going, man, that's a absolute shit thing to do, right?
Exactly.
And again, it gets down to, it's not about payoffs, it's about consequences, right? If you take a really big risk, you might get rich, but you might also lose all your money. Okay, so long as you understand that, best of luck. But that's a really, it's a really dumb bet.
Oh, you may as well go play roulette.
We'll play lotto, right?
Yeah.
And there's a chart below that just showing you that there are periods, and it's quite substantial, where the S&P doesn't outperform Treasury bonds, right? And again, and when you look at it, it always gets back to the market being cheap or expensive, right? And if it's expensive, the earnings yield like now is 3%. Well, for Christ's sake, why do you think you're going to get 10 or 11? Right? It's saying you'll get 3. So what, you're sitting there thinking, oh, well, it'll probably, magic will appear and I'll get 11. It's like, that's not the way it works, buddy.
If you manifest it.
Yeah. If you, what is it? If you build it, they will come or something. It's just really basically, and again, what we're talking about, it's just really simple numbers. If people come at you with bullshit spreadsheets and, like, oh yeah, but if you do this and you do that, and you set up a trust and you negatively gear it, and you do a tax haven in the Caymans, it's like, oh Jesus, please, like honestly,
just buy when it's cheap.
Yeah.
Well, but Jacob,
and go on a holiday when it's expensive. Right. Take this time, go on a holiday.
But it's so true, isn't it? Yeah. I don't know. I'm 62 and I'm looking at it, mate. I'm not kidding. I'd happily live in a caravan.
You want a caravan?
I'm not kidding.
Go get one.
Someone buy Steve a caravan.
As soon as I dump the kids, I'm going to get a bloody van and go, this is it. I'm just going to drive around, and as long as there's Wi-Fi, I'm happy.
You're going to have to just drive back here every Friday.
Yeah, that's trght. Well, he'll be in Mulaney.
Yeah.
True.
What about him?
Yeah, that's fair.
I'll drive here.
Yeah.
Steve's coming over from Perth today, so we might be a couple of hours late.
He can fly over.
Anyway.
Before we wrap up, I did want to cover the signals and noise premium. So a bit facetious saying got to pay for the stock picks, but what you actually get are monthly coaching calls. There's about 3 years worth of previous coaching calls, all Steve's notes, Steve's way of thinking for investing. Obviously, there's a small fee behind it, but if you're interested, you can head to the website. There's actually a lot of good stuff. So, thanks,
Awesome.
See you next week.
Cheers, folks.
Cheers.
This podcast does not provide financial advice.